Welcome to the Lend Academy podcast, episode number 32. This is your host, Peter Renton, founder of Lend Academy. Today on the show, we're doing something a little bit different. We have a bank on. Not just any bank, this is Cross River Bank. And we have Gilles Gade, who is the CEO and founder of Cross River Bank, and Adam Gola, who's their VP of Lending. And, I've known of Cross River for some time, and I got to say, in the last 12 months, I see their name everywhere. It seems that every single new platform that's launching, a consumer platform that is using Cross River Bank to really help them originate the loans. So wanted to get them on the show, find out exactly what they do, because I got to admit, I didn't really know the ins and outs of this. So I learned a lot, and I hope you do as well. Enjoy the show. Well, welcome to the podcast, guys.
Thanks, Peter. Thanks for inviting us.
Okay. So let's get started just by giving the listeners a little bit of background about each of you.
My name is Gilles Gade. I'm the founder, chairman, and CEO of Cross River Bank, a bank that was created about 7 years ago. Prior to creating Cross River Bank, I was involved in the investment banking industry, and prior to that, I was in the venture capital world.
Adam Gola, I currently function as the Chief Credit Officer of the bank and oversee the entire lending group. I joined the bank actually before launch, more than 7 years ago, and currently, vis-a-vis this call, I'm heading up the MPL platform growth.
Okay, so I guess, why did you decide to start a bank? I mean, 2008, was it 2008? That's an interesting time to start a bank.
That was, I would say in retrospect, it probably was the best time to start a bank.
Really?
And, starting with a clean balance sheet and being able to deploy our capital and our cash in quality assets that had been pretty much cleaned up after the debacle. We pretty much dictated the terms of the loans we were deploying. In addition, we participated in some interesting program, actually a little bit like a hedge fund, deploying assets such as our capital in assets such as SBA pools, MBS, ABSs that were AAA rated and guaranteed by the faith and credit of the U.S. government. And we participated in a program called the TALF program, which basically consisted in the government providing 20-to-1 leverage for quality assets, AAA and up. And that pretty much provided us with very quick earnings, which out of the gate, we managed to turn a profit, I would say, in quarter number 5, which is quite unusual in the banking industry.
Indeed. That sounds pretty impressive, particularly given the timing. I mean, I think, people remember back in those days where we wondered whether, was Citibank going to go under? It was and some of these big banks that, people were just wondering how it was going to go. So full credit to you for, coming through that strongly. So I guess, you started a bank. I mean, I presume you started a bank without thinking about, peer-to-peer marketplace lending. So when did that first get on your radar?
So that's actually a very good question. We got acquainted with a platform called Green Sky Credit out of Atlanta, Georgia, which basically was originating loans out of the Home Depot for the at-home service, which consisted in providing home improvement loans to consumers for renovating kitchens, flooring, sidings, windows, and doors. And we were kind of one of the first banks to participate in the program. We ended up being the only bank in the program at some point because the first bank that was in the program defaulted and during the debacle, during the credit crisis. And very rapidly thereafter, Green Sky turned around and found another 11, 12 partners, banking partners, and we were overtaken by the volume. We still are very involved with Green Sky, but what that did is that it gave us an acquaintance with and an expertise in consumer credit, that's number one, and number two, with third-party arrangements. And I think this is key. At the end of the day, the marketplace lending is a consumer loan, traditional consumer loan. It's not revolving, naturally, but it's still a consumer loan that is underwritten like a consumer loan. And most of the platforms underwrite based on FICO scores. But at the same time, it's also a third-party arrangement. And because we had a leg up, thanks to our Green Sky relationship, we managed to very quickly and rapidly cater to the platforms that were coming to us. So Peerform, I don't know if you heard of, you probably heard of Peerform naturally.
Of course, yeah, I know Michael quite well.
Michael was actually the first one to knock on our door and say, and he was a friend of mine from a prior acquaintance. And Michael came to us and said, well, why don't you partner with us and provide us with the true creditor status that we need to deploy those loans nationwide. And we were very intrigued by the idea. And he said that also, there were only three players at the time, Peerform, Prosper, and Lending Club on the consumer side. And he said, and I know Renault pretty well, and I'll make an introduction. Maybe you could do something with him. And that landed us with the backup relationship with Renault and Lending Club some 4 years ago. And we've been a relationship of Peerform ever since, and the rest is history. Then we started accumulating platforms probably in the last 2 years that accelerated dramatically. And I think today we have something like 14 platforms live, and we have another 3 to 4 due to close within the next 2 months, at least in the first quarter. And then we have probably another 5 to 10 before the end of the year.
Okay, so, and I know, Adam, you've been really taking the lead on this in your push into this industry. So what is it that sort of demonstrated to you that this was such a big opportunity when there really, there was only 3 platforms and, that's not a great business if there's only 3 customers. So what made you think, this is back, we're talking, 3 or 4 years ago. So, this is back before the boom. And, so what made you really seize the opportunity?
I think, to answer your question directly, I think Gilles mentioned earlier he has a background in technology from his days in investment banking. I think that the bank has prided itself from day one on being very focused on technology. And when you look at technology and you see the way the world is progressing, even the banking world, you see an opportunity to make everything more efficient through technology. So when you talk about delivering loans to consumers, to businesses, and to real estate, you try to look at technology and say, how can we use technology to make that better? So when you see companies like Lending Club and Prosper utilizing technologies with Phyllis and offering a better service to customers, to the bank, to our bank, who tries to really pride itself on using technology, it was a no-brainer. We saw the next frontier was right at our doorstep. So it really wasn't necessarily the marketing or the companies themselves, although I think they did a great job in acquiring customers, mostly today actually through mail. But it's really the platform itself and the consumer-facing applications that I think made the bank, realize what an opportunity existed over here.
Okay, so it sounds like you've got a couple of different products, shall we say? Like you're doing backup for Lending Club, and you're the primary servicer for 14 platforms. Can you just give us a bit of a rundown of how those relationships differ? I actually want to go and dig into the weeds pretty deeply here because it's something that I don't fully understand, and I know a lot of people don't fully understand what is the mechanisms that are actually in place that force these platforms to use someone like you. So let's just start off with the Lending Club relationship. Explain how that works.
So Lending Club is obviously a very different relationship. As you mentioned earlier, really we're backup for them. So we're not actively originating with them. For Lending Club, due to their size, it was necessary for them, particularly as they were going public, to have a backup arrangement with another bank. So that's really the relationship there. It would take definitely some time for us to get up and running, but we do have a relationship where we could step in should a bank fail to originate or fail to meet their end of the bargain. So Lending Club is unique, and maybe we should put them to the side. With regard to the other platforms that we are actively originating for, I think for the most part, from a process standpoint, it's very, very similar in both how we board the clients as well as how we service the clients. We have pretty refined processes and procedures that really dictate how the funds have to move, what accounts need to be set up, what information needs to be taken from them in order to get them up and running. But I think that it's really the overall process that I think has made or allowed the bank to get or to add these platforms at such a prolific pace. With regard to the different industries we're in, you mentioned earlier, Lending Club is sort of a generic term for consumer loans, but there's other platforms that are really focusing, their efforts in very specific markets, whether it be a wedding finance or whether it be social finance or it could be point of sale finance or it might be in solar. So I think that, the platforms are really identifying themselves merely more from a marketing standpoint, more than from a process standpoint vis-a-vis the bank. From the bank standpoint, it might matter when you talk about credit risk, what area they're in, or it might matter when you talk about is there security on the loan, like it would be in solar or in, let's say, auto finance. But with regard to how the bank, boards and looks at these clients and then obviously services these clients, there are a lot of similarities in process.
Okay, so but let's just dig a little bit deeper here. So let's just say, XYZ platform originates a loan, investors are invested in a loan, a borrower does the application, they've got a loan, they pass it to you guys. What happens exactly then? Like, do you get I presume you get a data file daily or hourly or whatever, but can you explain the exact process of what you do once you've got this borrower from XYZ platform?
Yeah, so on a daily basis, obviously what the platform's up and running, on a daily basis, based on the pre-approved or predetermined criteria that the bank has presented to its board of directors, the sponsor, we'll call them in this case, or the platform, originates loans. They then send us a data file, a standard data file, which we give to them before they start. And based on the data file, the bank then scrubs those files to make sure that they adhere to both internal criteria as well as have all the required documentation, like the note, the identification, things of that nature related to AML and other regulations. Once the bank has determined that the file is clean and ready to fund, the bank then sends out its own funds directly to the borrowers through ACH. The borrowers receive the funds. The bank, for the most part, in most cases, would then originate the loan, hold the loan on its books for anywhere from 2 to 3 days in most cases, or some are a little bit longer, and then sell the loans back to either the platform themselves, meaning the sponsor, or one of their investors, in a nutshell.
Okay, so the investor money that the people have put in, that never comes to you. So you are you saying you originate the loans with your own capital and then you get paid back after the fact?
Yeah, to be very clear, the bank always originates the loan with its own capital. In some cases there is a full collateral account or a partial collateral account with a corresponding balance that equals the loans to be funded plus the loans outstanding. But the bank is always using its own funds, not the funds in the collateral account to fund loans. Obviously, when it comes to talking about true creditor, the bank has to use its own funds. The fact that we have some protection to make sure those loans are purchased in the form of a collateral account, whether it be a 1-to-1 ratio or a 1-to-4 ratio, that's obviously a protection for the bank, but that's not how the bank funds its loans. I want to touch on something earlier. When the bank looks at the loans on a daily basis, it's not a completely manual process. The bank has a lot of technology that it uses, both on the AML side as well as on the document review side, that it both has already implemented and is continuing to implement to create more efficiencies in reviewing these documents. Obviously, as we add platforms and as each platform adds volume, it's going to be very important for the bank not to have to hire either one person or per platform or for two platforms. The bank plans on scaling the technology, and that's a very important part of what we're trying to accomplish.
Okay, but so if you have, say you get, it's probably not there yet, but lending clubs up to close $500 million a month, that starts to get real money. Do you have enough capital to I'm sure you've thought about this, obviously, to really sustain a boom and say you get 10 times the size you are now with your transaction volume? Does that impact you as far as capital goes?
We do have enough capital right now to be able to grow the activity to close to $10 billion standalone. In addition,
is that an annual? That's an annual number? Or
that's an annual number. So that
okay.
means it's close. It's actually closer to 11 billion with our current capital.
Okay.
So that means close to $1 billion a month.
That's well over what Lending Club and Prosper are doing right now. Yeah.
That's right. And then we have a bank holding company that we haven't tapped into yet, with the ability to raise equity. Actually, it's debt at the bank holding company level, and you can push back that debt as Tier 1 capital downstream to the bank, which would increase our capital to a point where we can actually have excess marketplace lending origination capacity to $30 billion annually.
Okay, so that should last you for a little while.
That's right,
yeah.
Exactly. So we have no capacity problems here. That's the least of our problem.
So you don't have to give exact numbers, but can you explain how you make money in this industry, in the marketplace lending industry?
Sure. There are two ways to make money. Number one is to charge a fee per loan, and that fee varies anywhere between 20 bips to 100 bips on the loan amount. And the second way is while we're holding the loans on our books, we collect the interim interest. So if the note rate is at 14%, for example, we collect that 14% for those 2 days that we're holding the loans on our books. In addition, what we started to do about 6 months ago with Marlette particularly, and we're very excited about it, and I think we're coming out with it now in a big bang, in a big way, on your podcast, and we plan on writing an op-ed that hopefully you'll be able to post on your blog. And it's the fact that we are holding loans on our balance sheet. And this has two effects, two very important consequences. Number one, it adds revenues to both us and the platform because we're sharing on the revenue, the income derived from holding loans on our books. So instead of sending the loans to a hedge fund, for example, and foregoing most of the interest and retaining the servicing fee, we're willing to act a little bit like a warehouse lender for the platforms and sharing in the revenue of the upside of the interest above and beyond the charge-offs and the cost of funds. We started doing that with Marlet. It's working out very, very nicely. And the second point that I would like to make that is really of consequence, I would say, is the fact that this really adds a lot of teeth to the true creditor status. Because if you're putting your money where your mouth is, you're not only saying, I'm holding the loans for 2 days, but in addition, I really believe in the platform to a point where I'm actually taking 10% of the loan origination on our books and holding it. So these are the various ways in which we're making money on these platforms.
So how long are you holding it, the 10% you're talking about? What's your time horizon?
So technically it's held to maturity. However, we're going to start securitizing or selling pools of loans in the secondary market, probably starting in the next 60 to 90 days.
Very interesting.
Once we accumulate a critical mass. So this hasn't been done at the bank level yet. It's been done by people like Eaglewood or Granite and others, BlackRock recently, but it hasn't been done at the bank level. And the very attractive thing for the platforms here is the fact that we're going to share in the revenues of even the residual on the securitization model.
That is a very interesting development. I was not aware of that, and I think you'll certainly be breaking ground there. So is that going to be with Marlet initially, or can you share?
Sure, it is. It has been with Marlet for the past 6 months, and we intend on offering that to a couple other platforms that we really like. And so basically, the way we select the platforms that we're going to do this with is we have our own rating system of the platforms internally based on the due diligence package, the servicing expertise, the capital adequacy, the backers, the VC backers behind the platform, the experience of the management team. So we put all these basically into a big soup, and what comes out, and it's more qualitative than quantitative, by the way, but what comes out is basically the platforms that we select to participate in this program. And we dedicated a part of our balance sheet, and basically the big message here that is very important, Peter, for you to relay, is the fact that we're in this industry to help it and to invest as much as the platforms are invested in it. It's not just a way for us to run the charter and to make a quick buck along the way. It's truly to invest fully and to prepare our balance sheet, to position our balance sheet to assist those platforms to be able to grow and to fulfill their aspirations. I think there is tremendous growth potential here. And I fully embrace Renaud's vision for the past 3 to 4 years. He's been screaming it. And now we're starting to see the fruits of his labor. And all the platforms that are participating in this endeavor and this intermediation business, we're here to help it, not to hinder it or to compete with it. So in our way, that's how we're trying to participate in this growth by putting to contribution our full, strength of our balance sheet and our capital.
Okay, I think that message has been received loud and clear. It's great to hear. I think I think the industry needs a proactive bank like you involved. And now I want to dig further into the weeds a little bit, and I want to get into banking regulation and lending regulation in general. Why can't Lending Club or anyone else, any other consumer platform, why can't they originate the loans themselves without help from you? What's preventing that?
The reality is they can. That's the simple answer, right? If they wanted to go license themselves in every state and be subject to both state regulators as well as the CFPB for complying with all the state regulations, they could. I think that the platforms realize that there are certain states in which that would be very difficult to do so, and not to mention the manpower required to maintain those licenses as well as handle the audits that will be required of them. I think from a simplicity standpoint, when you think about what they do best, which is customer acquisition, technology, I think that it's in their best interest to use a bank. For the most part, and depending on a bank, it doesn't really cost them a lot from the revenue of the loan. And I think that the bank brings a lot to the table in both, I think, offering not only its charter, but also legitimizing the loans, vis-a-vis the borrowers. I think a borrower who sees a loan from a technology company certainly doesn't look at it the same way they look at it from a bank. So I think there's multiple advantages that using a bank brings to the table. I think one is vis-a-vis compliance, two vis-a-vis regulators, and three, I think even client-facing. I think for the clients, I think it's also very helpful.
Okay, so you're obviously a federally chartered bank. Does that mean you have lending licenses in all 50 states? I mean, have you had to go through this process? Because I mean, when you started off, you're based in New Jersey and you're focused on New Jersey clients, I imagine. But what is the licensing process that you've gone through?
We're a state chartered bank. We're chartered in the state of New Jersey, but we're FDIC insured, which allows us to lend nationally, and not only lend nationally, but also export the bank's state rate nationally. That means 30% for consumers and 50% for businesses. I think that that's what allows us to participate in the 50-state model.
Okay. So there was 30% APR is the maximum in New Jersey for consumers.
That's right.
Okay.
Right. Yeah.
Okay.
Which is fairly favorable. Naturally, Utah is more favorable than that at 36%.
Right.
But most of our platforms, actually all of our platforms, are satisfied with the 30% rate. Particularly, there are competitive pressures on the pricing today, on the rates, to be able to gain access to certain consumers. In addition, there's going to be a stigma to, the higher the rate, naturally, the bigger the stigma. So most of the platforms have expressed the interest and the willingness to stay within an interest rate that remains under the radar in terms of stigma, in terms of scrutiny.
Right. Yep, that makes sense. So you mentioned Utah, which we know WebBank has had the relationship with Lending Club and Prosper almost from since they had to go through SEC registration. How are you different to WebBank? And do you have a relationship with these guys?
We don't. I mean, we have an open dialogue. We respect those folks a lot. Naturally, they were the first. They benefited from the first mover advantage. We're following in their footsteps, and we're catching up somewhat, I hope. But in the meantime, it's a healthy competition. I think that we both play right now in a very different market. They naturally have the two 800-pound gorillas in the Lending Club and Prosper, and a couple of others. We have pretty much everybody else enjoying that dynamic. I think the market naturally will evolve in the future, but in the meantime, I think we really learned a lot from them and from their being a bellwether in this market in terms of how to properly bank those platforms. And we looked at their work papers way back then. We looked at a lot of things that they had accomplished, and I could only say that it's a good thing that they were here first, and we managed to just piggyback on their knowledge.
Right. Yeah, fair enough. So I wanted to just switch gears a little bit, and I wanted to talk about the platforms you're currently working with. Now, you mentioned Marlette as the market. They're a marketplace lending platform. It's they're doing great. They're fairly new, but can you share some of the others that people might recognize?
Sure. I mean, there are a few that have been made public. I mean, they themselves made a relationship public, such as Upstart, Affirm, Borrowers First, Vouch, Peerform, naturally, and then I believe that's about it that we can disclose. And there are a bunch of others that are fairly active. That I'm just going to talk in broader terms. They're in the various areas that Adam mentioned before, which is debt consolidation, naturally, and then there are a few other platforms in the debt settlement business, and as well as the solar installation business, and a couple of others.
Okay, so do you have small business lending platforms as well, or is it mainly the consumer, apart from like the solar, which I guess is small business?
No, we're predominantly a consumer shop. However, we already have two small lending platforms, so small business lending platforms, and there are a few others that are existing that have expressed interest in talking to us. So we're exploring. We're trying to better our compliance as well as internal procedures to handle those platforms, because they're naturally very different animals, and the compliance requirements are very different.
Right. So let's just imagine I've got a new marketplace lending platform, and I'm getting going, and I need someone like you to help me. What kind of due diligence do you do on new platforms that come to you?
I mean, it's everything from review of management resumes and board of directors to looking at projections and looking at their policies and procedures and compliance knowledge. It's really a full review. Like I said before, it's a pretty rigid / refined process and relatively standardized. But if you want, we can drill down on any particular area, but it's really looking at the full breadth of both management and the platform itself. We do a deep dive into their credit algorithm to see who their target market is, how they plan on acquiring borrowers, and really, how they plan on achieving scale.
So do you, I presume when a startup platform comes to you for the first time, they don't have all their ducks in a row. I mean, have you, I presume you go through this process back and forth for some time. I mean, what's a typical time frame for this process?
Typical would probably be 90 to 120 days. The minimum would probably be 60 days, and then there's some that took up to a year to get up and running. We try to avoid that, but I think the two areas that we see that companies lack the most experience in, I think naturally is compliance, and then I think that from a process standpoint, I think that the other part is and maybe not unrelated, is just getting the back office operations in order to work with the bank. Most of these companies have very, very highly skilled technology programmers, very strong APIs and algorithms. But the areas that the banks focus on are less on the technology, not except for the security, obviously, but less on the technology and more on the compliance and regulatory matters.
Okay, so let's just dig into the compliance a little bit. What do you see as what are the compliance hoops that these new platforms have to jump through?
I think the issue is not really on them. It's more on the nature of the monster. I mean, AML compliance, I would say, is probably the most difficult area to comprehend. And even if you have a very strong AML BSA compliance officer on staff, you're still going to have a lot of difficulty setting up a compliant program. And the reason is because it's all gray areas. It's very difficult to pinpoint exactly what your level of checking are going to be until you test the program. So that's why we have a two-pronged process. What we do first is that we get their policy audited before they even start to write the first loan. And then 6 months down the road, we get their program audited by doing transaction testing. And that has worked in our favor. It has worked very, very nicely because we provide comments on the policy and procedures. And then they manage to fine-tune their process. And when they're ready to launch, they actually have a process that is almost, I would say, 100% compliant, but not quite. And we catch the mistakes within the first 6 months. So this is basically a proactive way of approaching the whole matter, which has made the regulators in general very comfortable with the whole concept of marketplace lending. Okay,
so do you ever talk with a platform who is just so bad and so far behind that you just say, look, we can't work with you? Does that ever happen, or do you always, find a way to kind of bring them on?
It really takes a lot for us to say no, to be honest with you, because we have a tendency. I mean, I as a former tech banker, I really feel for those companies, particularly in areas that they're not familiar with. And we want to help them basically grow in what they're experts at and let us handle the compliance to some extent. But they still have to have the controls in place. So it really takes a long time for us to say, no, but that happens. Listen, we signed over 84 NDAs, non-disclosure agreements, since the last Lendit, which was about 10 months ago.
Wow.
That's a lot of platforms that we look at.
Yeah.
And we only signed up 17 altogether, 14 that are live, and another 3 to 4, that are going to come live in the next couple of months. So that means that a lot of them fall by the wayside.
Right.
There are naturally some that go to other banks. I mean, I'm not aware of many banks doing what we do on a grand scale. There are always banks that do one-offs, and we welcome those endeavors. But the vast majority of those platforms have fallen by the wayside just by the sheer fact of the extensive compliance module that we impose on them. And number two, the due diligence package is humongous.
Right.
And those two factors have weeded out the platforms that are now ready to approach this market on a grand scale.
That's really interesting. I guess one question follow up with that. What's the cost for you guys to start this process? I imagine you're not doing this for free. It sounds like there's got to be some cost to you to start this process, right?
Well, again, we put ourselves in their shoes, and particularly in the shoes of the VCs that are backing them. And it's very difficult for a VC to put $2 million in a platform and to say, okay, the first $1 million is going to be spent on a banking relationship. It's not going to work. And particularly if they're not prepared for that and they haven't managed the VC's expectations. So what we do is that we charge an inception fee or due diligence fee of $25,000. That's pretty much a flat fee across the board. And then, naturally it varies if the platform is much bigger than that, but we're not going to go above $50,000, I would say. And then the ongoing process is usually subjected to a minimum fee. But again, that minimum fee is very reasonable. And we want to invest in the platforms, and we'd rather back-end that fee than front-end it.
Right. So you're obviously, if you're spending, 120 days or more on a due diligence process and you're charging $25,000, I mean, you're losing money on that operation, I imagine, but you're making it up on the back end.
That's right. And we're pretty good at this stage. I mean, not, in your past, but at this stage, having looked at 84 platforms over the past 10 months, we're pretty good at identifying the guys that are very solid, the management teams that make sense, the business plans that are sound. So we can identify the platforms we want to engage in. So that has helped us in pricing ourselves within market and accordingly within the platforms that we believe are going to be the winners of tomorrow, or at least the winners of the next couple of years, so that we can recoup some of that cost, the inception cost that we invest in the platforms to begin with.
Mm-hmm. Right. So I know you guys were at Lend It Europe in November. Adam, we had a chat there. I'm curious as to why you were there. Do you have international expansion plans? I mean, why go to London to really meet platforms there?
So that's Peter, you don't miss anything. That's what makes you the expert in this industry. This actually had a little bit of a different purpose. So first of all, we'd like to see and to know that platforms that intend on coming to the U.S., because we're well positioned to help them out.
Right.
Number two, the other side of the balance sheet, which is the deposit side, we have very neat technology-based transaction platforms, I would say, on the ACH front and also on real-time payments. So there's a whole spectrum of the fintech industry that we're exploring and also delving into. For the past couple of years, we have our own team of developers that have developed some pretty neat technologies that assist peer-to-peer or marketplace lending platforms and peer-to-peer payments platforms. So in addition to, again, that's going back to that expertise in the third-party arrangements, we're now putting our contribution and our knowledge to exploring relationships with international platforms that need an international payment solution and a very fast payment solution. And that's our interest in this industry as well.
That is really interesting. I'd love to delve into that, but we're running out of time here. So I guess, are you can you just give the listeners a bit of an indication of how much of your bank's resources and attention is going to marketplace lending now versus the traditional, bank loan, deposit taking, retail type banking operation? And as far as revenue and that kind of thing?
I would say 50%.
50%. Okay. Okay. So, if we were your future plans, I mean, obviously you touched on it there, Adam, but just for the marketplace lending platforms specifically, is your plan just to keep adding new ones, becoming the Goliath of the space? What are the plans?
We'd like to try to add new partners, obviously strategically, not just adding partners for volume or just to have them under our wings, but I think we'd like to try to identify who the winners will be and try to help them grow. I think that there's a lot of opportunity, and it's a very big market that can be shared by a lot of different companies. But I think the bank, has done and will continue hopefully to do a good job of identifying who the companies are who can be successful with the requisite knowledge in all the areas you mentioned earlier, whether it be technology or banking or compliance.
Okay. Well, on that note, I really appreciate your time, gentlemen. It's been fascinating. I've learned a lot, and I hope the listeners have as well. Thanks a lot.
Thank you, Peter.
Have a good day.
Okay. See ya. Okay. Well, that was fascinating to me. I certainly learned a lot. I now have a much better understanding of the exact pieces of the relationship between banks like WebBank and Cross River Bank and the platforms. I see what a great service they provide, particularly Cross River, I think, who is sort of implanting themselves right in the middle of the ecosystem here and are doing a great job of providing added value to platforms. So anyway, I hope you enjoyed the show, and I will catch you next time. Thanks for listening. Bye.